Great. Welcome you all once again to the continuation of the investment appraiser. We are still at the net present value method of appraising projects. But before that, there was a trial question in our previous lecture. So let's go and pick it up and do justice to it. Fact required. Should the investment be undertaken using payback and adjusted payback period and the accounting rate of return? Yeah. If the cost of capital is 12%, that question is in the example 9. If you go to example 9, it's here. So example 9 is here. So I use the data in example 3 with a cost of capital of 12%. Should the project be undertaken using what? Adjusted payback period. So we are doing all together. We are doing all. So 3 requirements. Now let's go back to the example 3. Good. Example 3 is here. Now let's see. So you are going to calculate payback period, adjusted payback, and accounting rate of return, ARR. And here with the ARR, they have to give us the target or the minimum ROCE. Now let's see the question. Target Publications is considering buying a piece of land at a cost of 87,500 for a project and an investment of 12,500 in working capital. The project will have a 4-year life. Good. 4-year life. Great. 4-year life, after which the land will be disposed for 3,125 Ghana cedis. The project is expected to earn the following net cash receipts. Net cash receipt, which does not include an amount of 18,000, which will be incurred in the first year of operation, but it will be paid in year 3. I like that. The timing of the cash flow is very important. The cash flows are here. So all of them are there nicely. Consider year 1 cash flow is same as the year 3. That's all that. So first, let's calculate the normal payback. So normal payback period. So how do you calculate the payback period? Let's quickly clear this from there. So join me and let's do it together. So first, tell the examiner that we are calculating what? Payback period. Good. With the payback period, they said that you need, in fact, let me shift it here so that I can do the many ones at the other end. Let me start from here. Good. So payback period. So first, I have to look at my year. Payback, we use what? Cash flow. And then the balance. That's all. That's the payback. Cash flow will be in Ghanaian cedis. So take notes. We have year 1, year 2, year. In fact, with the payback, we said that we have to start from where? Where the cash flows start from year 0. So therefore, Start from year 0, year 1, year 2. The same project will last for how many years? 4 years. So 3 and then 4. These are the years. So let's go ahead and estimate the cash flows. Now with year one we normally, let's start from the year 0. Year 0 means now, and usually that is where you have to pay the capital cost of the project. The capital cost is 87,500 for a project, and an investment of 12,000 in working capital. So it means that the cash flow for year 0 will be addition of these two, 87,500 plus the working capital. So that is it. So therefore, great. So therefore, the cash flow for the first year will be the 87,000, that's the year 0, 87,500 plus 12,500. And these two will give us, that's 100,000. Good. That will give us 100,000. So that means that the cash flow for year 0 will be 100,000. So basically, here will be 100,000. I'll put in brackets. It was 87,500 plus 12,500. Addition of the two, working capital. This is working capital, this is investment itself. Good. Then year 1 cash flow. But there's something here. The examiner said the project is expected to earn the following net cash flow, which does not include an amount of 18,750, which will be paid, so which will be incurred in the first year of operation. So that's year 1. They will incur it here, but it will be paid for in year 3. So it means that where are you going to place such cash flow? They will incur it in year 3, but we incur it in year 1, but they will pay for it in when? Year 3. So where are you going to include it? So it means that it must be part of year 3 cash flow. Here, because payback uses cash flow, where you are going to make the payment, that is the consideration point, or that's where we consider where you are going to make the payment, not where you incur that cash flow. So as long as they are going to pay it in year 3, it doesn't matter where they incur that cash flow. They are going to incur it here, but to be paid here. This is cash flow, not accrual basis. This is not profit. Where profit, accounting profit, they will tell you that transaction must be recorded as and when they occur, right? Cash flow is not like that. When there's cash movement. So take note. Great. So let me take that section again for the last time. They said that the project is expected to earn the following net cash receipts, which does not include an amount of 18,750, which will be incurred in the first year. So that's year 1. But it will be paid in year 3. And here, because we are looking for cash flow, it must be in the year 3, not year 1. So because of cash flow, the timing of the cash flow is very important. The timing of the cash flow, very important. So it means that I will reflect it in year 3. So when I get to year 3, I will reflect it there. So it means that year 1, the cash flow will be 56,250. So 56,250. And then year 2 is 30,000 negative. And then year 3 is 56,250. But I have to subtract 18,750 from it, because that's where they will pay. So they are going to pay out of this money, 56,250. So let's take 56,250. Let's take 18,750 from that figure, and then we arrive at what? 18,750. So it will be year 3 cash will be 56,250 less 18,750. Why? Because they are going to incur it when? Year 3. That's all. They are going to incur it in year 3. Good. So what will be the answer? What will be the answer? So 56250 less 18,750. If your answer is in, you can share it with me. That's 37,500. So that means year 3, the cash will be what? 37,500. That is year 3 cash flow. That's 7,500. Let's go and pick the year 4 cash flow. Year 4. So estimation of the cash flow is very important. Now year 4, they have 15,625. Here what you have to do is you add if there's any scrap value. So they are going to sell the land for what? 3,125. 3,125. It must form part of the cash flow. Yes, because when they sell it, they'll receive what? Cash, not profit. So that 3,125 must be part. Wait, 3,125 will be part. So therefore, what do we do? We just have to add. So now let's go 15,625. So 15,625 plus 3,125. And basically that will give us good 18,750. Great. So let's go and put it down. 18,750. So 18,750. Okay, we are looking for a payback period. Now let's see. How long will it take us to recoup this amount from the project? So therefore, we will start. As at year 0 now, we have invested 100,000 to the tune of 100. So we still have 100,000 to clear or to be recouped. At the end of the first year, we had a net cash inflow of 56,250. So therefore, we are going to use it to offset our investment. So let's see. So the 100,000, 1, 2, 1, 2, 3, less what? 56,250. That will give us 43,750. It will be 43,750. What happened in the second year? In fact, in the second year, they had a loss, net loss or cash outflow. They spend more than the receipts. So therefore, leaving a negative balance. So it will increase. Here must be negative. So it will increase this negative to what? 73,750. And hence, we are moving on. Then the next section, they had a cash inflow of 37,500. Cash inflow of 37,500. So at least it will reduce the burden, right? Good. So let's 37,500. And that'll give us 36,250. 36,250. 36,250. Then the last year, they still had 36 to go, but they have 18,000. Let's try and use it to offset some of the loss. So 18,750. And that'll give us 17,500. But they still have 17,500 to clear. So who can calculate the payback period for me? So who can calculate the payback period for me? And that person will be the accounting cracker for the night. Start work. The payback period. Now, payback period says or determine how long it take us to recoup. In fact, this project cannot pay back the capital investment. I like that. The project cannot pay back. So no payback period. So here from the above, the project cannot pay back. The project cannot pay back. And hence we have to what? Reject the project. Good. Cannot pay back the capital investment and hence reject the project. We said that the acceptance criteria of payback period is that accept the project that can do what? Payback. We are done. Now what about the adjusted payback period? Now let's move on to the adjusted payback period. I will just have to do adjustments. Here the cash flow must be discounted. That's all. Now let's discount the cash flows. So I'll just extend the line. Just have to take this section off. In fact, the truth of the matter is that since the normal payback rate, we're not able to pay back, but the adjusted payback will be worse. It will be what? Worse. That is it. So let's see adjusted payback period. So let's solve the adjusted payback period. So here will be, let's call it adjusted or discounted payback period. Payback period. Good. They remind me that there was an outstanding work. Here's the discount factor at what? 12%. We find the PV of the cash flow, present value of the cash flows. Then we now do the balance. Now, the present value will reduce. So let's find the present value. As usual, 1 divided by 1 plus 0.12 all to the power. If I add 0, put 0 there. But always here 0 will be 1 because we said that 1 Ghana cedi today is the same as what? 1 cedi. So unless there's what change in time, we call it time value of money. It should be 1 cedi. If I put 1 here, what will be the answer? If your discount factors are ready, you can share them with me. So 1 divided by 1.12, that will give us to 3 decimal places, .893. I like that. So for the year 1 will be 0.893. Agreed. 0.893. Then this again divided by .12. That's 797. I like that. 0.797. followed by now divided by 1.12. That's 712. So 0.712. And here what? 0.7 part no. Let me wait for the answer. The last one will be 0.634. Now let's find the present value. So discount factor times the cash flow should give us the present value. But this is interpretation. If I have one Ghana cedi, in 0 years time, I'll receive one Ghana cedi. So it will still be the same value, 100,000. If I have one Ghana cedi, exactly 1 year, I will have 89 pesos. But I'm having 56,000. So how many cedis will I receive? I'll multiply. I'll be get it. Good. Is 0306? 06, eh? Thank you. Good. Okay. Good. I'll take that. So now let's go to the present value. 56,250 times your 0.893. And the answer will be good. And then you are doing the next year. So 56,250 times 0.893. And that will give us 50,231. So you'll be 50,231.25. Agreed. Okay, so let's run to the next one number. Now the next one will be 30,123 times 0.797. That will give us 23,910. So 23,910 to be in brackets. Then the next one will be 37,500 times dot 712. That's 26,700. 26,700. Agreed. And the last one will do that for me. Kindly make sure that you are getting the same figures, because now we are together. A time will come you will solve it alone. So make sure that you get the same answer. So 11,925. 11,925. Now let's calculate the balance. The balance will be, as it stands, still the balance will be 100,000. At the end of the first year, the present value is 50,231. We are going to use that one to offset it, so the balance remaining. So 100,000, 1, 2, 3, less what? I like that. If I didn't run your answer, eh? So 49,769. So 49,769 to be in bracket. And then we will top it up. So 49,769. Good. Plus what? 23,910. So 73,679. Okay. So 73,679. So that will be the balance at the end of the second year. Then at the end of the third year, at least we have 37,500, but the present value is 26,700. So we can offset this amount from it and we get 46,979. So 46,979 still be negative. And then lastly, we're able to recoup 11,925, and then to reduce it to 35,054. 35,054. So have you seen that if you adjust the cash flows, the loss is what more? So hence this project not be able to pay back. So the payback period cannot be determined. This project must be rejected immediately because cannot what? Pay back. If you are using payback period. Okay. So basically that is it. Now let's calculate the accounting rate of return for the same projects. And kindly take notes of that. Now let's calculate the accounting rate of return. Don't forget the accounting rate of return uses what? Profit, not cash flow. Payback uses cash flow. So that's the difference. These two people, they don't agree. One is coming from profit section, and one is coming from the other section. That is great. Okay. Now what we do is this. Accounting rate of return. You are welcome. Accounting rate of return. ARR. How do you calculate ARR? Don't worry. We said there are three steps. Step one, get your average profit. Step two, get the average investment. Step three, divide these two answers. Multiplied by 100. You are done. That's all. So, accounting rate of return will be equal to the final answer in step one divided by what? Step two. All times what? 100. So, in short, accounting rate of return is equal to average profit divided by average investment times 100. We are done. And then we have to look through this. So, let's start with the average profit first. Average profit, you're welcome. So now let's see, how do you get the average profit? So first, tell the examiner a year. We are looking for year, please, not what? Cash flow. So, but what they're giving us is a cash flow. So we have to convert the cash flow to suit profit. So that means depreciation has not been subtracted. So at the normal circumstances, we have to calculate our own depreciation, take it from this cash flow to get what? Profit. So let's record the cash for year one, year two, year three, year four. Please, here we need accounting profits. That's one thing about accounting rate of return. It uses what? Accounting profit. Let me write it here. Accounting profit, but not cash flow. So how you calculate your profit or loss? The same way we have to work for year two. Now let's see. Now let's see. So they have given us the cash flow year one. With the account rate of return, you have to start from year what? Year zero. Payback, we start from year zero. With the account rate of return, start from year one. So sorry about the first statement. With payback, we start from year zero. With the account rate of return, start from year one. So let's go and record the cash flow. But here there's trick in the question. Inherit trick. Hey, trouble. What's from the question? Where is our question? Good. Okay, so the question is in. Great. Now, and this is net cash flow. Good. So let's calculate that depreciation. And don't forget that it's a piece of land. We don't depreciate your land. Yes, we don't depreciate land. Even though we are going to use this land for 4-year period, land should not be depreciated. Yeah, yet you have to follow that rule. So no depreciation. Wow, then that's good news. So that means the profit and then the net cash flow, they are the same. Just that here, the 18,000, I'll take it from year one. I'll not take it from year three. Why? Because they will incur it. Accounting profit, transaction must be recorded as and when will they occur, not when you pay. So using accounting profit, this 18,000 will be what? Will be subtracted from the year one, not the year three, where they are going to pay it. Because profit different from cash. Their timing is different. Profit is what occur, and then the cash is when it moves. That's all. So here too, we will have the 56,000. So you are right, profit slash profit. 56,000. So 56,000 less 18,750. In fact, it will give us the same answer as what? 37,500. Yes, though loss of 30,000. You put it in brackets. Here we still, so that means here we'll go back to 56,250. But here we are looking for profit, not cash flow. We are going to record the actual profit. We are going to record actual profits. Good. So it's 15,625. So 15,625. Have you seen the difference, right? Yes, you are calculating profit. Now we sum it up. Let's sum it up. So let's put them together. So what's the total profit? So that we find the average. Total profit will be 37,500 plus 30,000 plus 56,250 plus 15,625. That's 79,375. 79,375. Good. Then let's find for the average. What will be the average profit? So how many years? The number of years, right? The project will last for how many years? The project will last for 4 years. So let's divide this one by 4 so we can locate the average. So therefore, the average will be good. So average profit will be the total profit divided by the number of years. So this one gives us 19,844. 19,844. Now let's go ahead and calculate what the average investment. How do you find average investment? The initial investment plus what? Plus the scrap value all divided by 2. So let's see. In fact, I want to demarcate here like this. Continuation. Average investment will be, so let's start with average investment. So the initial investment, we had 87,500. Working capital, no shortcut. We have 12,500. So putting all these, we have 100,000 plus the scrap value. What's the scrap value? 31625. Let's go and pick the square value. That's 3125. So 3125, that's the scrap value. 3125. So 3125. So the total, you just divide this one by 2. So to give her 103125. Then, therefore, so the average investment will be this answer 125 divided by 2. We are done. Good. That will give us 51,563. This is equal to 51,563. So therefore, accounting rate of return will be finally to be the average profit of 19,844, all divided by 51,563 times 100. What's the accounting rate of return? And then we are done with this question. If you do have any question, kindly ask before I close the chapter of this. And then we'll move on. So what is the accounting rate of return? And this must be compared to 38%. 38% is not bad. However, even though the project can not pay back. So what do we do? So it's equal to 38%. We are done. Good. So you can jot some few points down. Then we continue the game. Now let's continue the game. Okay. So we are going to continue our investment appraiser. That is the net present value method. Good. Please, a gentle reminder. There's a question here. Kindly, the very last question was your question. Oh, this very one, the handout. But you now, I promise that you do it for me. So kindly try the last handout. Last question here. You are trying it. You are calculating the payback period and then the NPV. And I believe strongly that you can do that. Good. Today, let's continue the game. From our last section, we have looked at the NPV in general. Today, I'm going to touch some few issues in the NPV, then to bring the NPV to a successful end. So first, I'll talk about working capital. Then from there, I'll talk about inflation and summarize NPV and bring NPV to a successful end. The rest is what? Question solving. Good. So let's see, working capital, how we should treat working capital. It's in the NPV layout. So that's the treatment of working capital, or how we arrive at working capital. Good. How we arrive at working capital. So working capital in MPV layout. There's a section in the MPV where we normally put the working capital there, and I promise that I'll pick it on its own and explain it. Good. Now, we said that working capital refers to the funds that you use to run the business on daily basis. So for instance, if you want to go into transport, after you buy the vehicle, you should also reserve some of the funds for fuel and petty maintenance. Some of the business, they need just one-time working capital, and that's all. Some too, they need daily working capital. Good. So basically, that is it. The issue is you have to know how you should account for the working capital in the MPV calculation, especially using net present value. That's the MPV. Good. So first, there are assumptions of working capital that we have to adhere to. If you get these three assumptions clear, I think we will be fine. Good. We will be fine. Good. So we've defined working capital. Let's assume that your project that you are looking for year one, year two, year three, and then it's up to year four. These are the working capital that you need. So working capital requirements. Working capital requirements. This one, the examiner has given it to you. So year one, you need 1,000 Ghana cedis. Year two is 1,005. For year three, you need just 800 cedis. And the last year, you need 900 Ghana. So these are the working capital that you need for the project. Now in MPV, how do you incorporate this in MPV? So the MPV to be start by saying year 0, year 1, year 2, and year what? 3, and year 4. Before we can record in the MPV layout, it must follow some rules. So let's go to the rule. If you get this rule correct, that is all. So I'll start with the rule. The rules are 3, or assumptions. Assumptions. So assumption number 1. This thing, you need a red pen. Yes. Assumption number 1. The working capital will be provided at the start of each year. It assumes that each year's working capital will be provided what? At the start of what? Each year. So at the start of each year, now let's see. At the start of year 1 means year what? 0. At the start of year 2 means year 1. That is it. But at the end of year 1 means year 1. Here means at the end of year 1. And then at the end of year 2. Have you know that 31st December 2002 is automatically the same as what? 1st January 2003. Basically like that. Good. So the issue is this. At the start of year 3 means year 2. At the start of year 4 means year 3. That's all. So that means, and these ones are factual. Let's assume that you want to start a business. You want to go into, how do you call it, trotro. If you use your entire savings to acquire one vehicle, yes, the vehicle is in. You will start working next year, exactly 1 year, you start working. Now, the vehicle, the fuel, will you buy the fuel upfront right at the start of the first day or first working day, or even a night before you go to work? Or you wait after the first year before you start buying fuel? No. So working capital must be provided at the start. So if I need 1,000 Ghana cedis 1 year from now, I have to make that 1,000 Ghana cedis available today. If I need 2,500 Ghana cedis at the end of year two, I have to make sure that at the end of year one, that 1,000 Ghana cedis is there, so that to enter into year two, and 1,500 Ghana cedis will be there for me. That is the assumption. So therefore, in my NPV calculation, based on the first assumption, the working capital value, whatever I have to provide for year one, must be there in year zero. So I'll put it here. So this is the NPV calculation. These ones are your workings, and all the examiner will give it to you. Great. That's fantastic. Now what do you do? So put it in bracket, because the outflow, I need money. I have to make 1,000 Ghana cedis available before the project starts. So to be what? Cash outflow. All outflows must be in brackets. That is it. I'm done for the first year. So that's the first assumption. So please, the assumptions, write them somewhere. This thing, you have to use red pen to write them all. Assumption one. Working capital for each year will be provided at the start of the year. That's the first assumption. So therefore, year one working capital must be there before the project starts. That's year zero. Assumption number two. After the initial working capital, the subsequent one, we only record the movement or the difference. So after, let me take it again. After the initial working capital, please. I did not say that after year one working capital. We said after the initial working capital, or after the first working capital. Good. The remaining, we only record the difference. If it increases, it's an outflow. If decreases, it's inflow. Let me take it for the final time. After the initial working capital, okay. So we said that with the assumption one. Let me start with the assumption one. Assumption one states that each year's working capital must be provided at the start of that year. So year one working capital must be provided at the start of year one. And we said at the start of year one means year zero. So this 1,500 Ghana cedis here must be provided at the start of year two. And at the start of year two means year one. So I'll come and put it here. This 800, which is we need for year three, it must be there at the start of year three, which will be in what? Year two. I'll come and put it there in that order. That's assumption one. Now we are going to assumption two. Assumption two states this. After the first or the initial working capital, the subsequent ones, you only record the difference or the movement. If it increases, it's an outflow. If it decreases, it's an inflow. We are done. Now let me back in the illustration. I think that will be more clear. So after the first or the initial working capital, which is 1,000, the subsequent one, I need to record the difference. When you go to year two, I need 1,500 Ghana. But don't forget that last year I provided 1,000 cedis, so I don't need to provide the entire 1,005. That's what assumption two is saying. So you just have to what? Provide the difference. So here it means that I have to top up. I have to top up by what? 500 Ghana. So I have to top up. If it increases, then outflow. So I'll top up by what? 500 Ghana. Let's go to year 2. So year 3. Year 3, I need what? 800 Ghana cedis. I need 800 Ghana cedis. This 800 Ghana that I need, I already have 1,005 cedis there. So what do I do? Oh, then let me reduce it. So that's reduced by what? 700. That one become a positive inflow because I have to take money from the business. Hello. Okay. Now with the second rule, it states that after the first working capital, after the first one, have you seen that when I recorded the first one, I stopped? Yes, because of the assumption too. I didn't say that, okay, because this one provided here, so let me record it here. No, I didn't do that. Not at all. The assumption 2 states that after the initial working capital, you only record the difference or the movement. If it increases, it's an outflow. If decreases, an inflow. So after the first working capital, that's year 2, I need 1,005. I need 1,005. Now with this 1,005 that I need, I already have 1,000 Ghana, so I don't need to provide the entire 1,005. I just have to top up. Good. I just have to top up by what? 500. That's the difference. You only record the movement. So difference between this and this, put it there. But I have to make it, I have to make sure that I make that money available at the start of the year 2, which is year 1. So therefore, that will be 500. I'll put in brackets. And when I go to year 3, I have what there? 800. And this 800, the movement, difference between this and this. Here it has gone down. It means that I have more than available. I have more than more working capital than what required. You have more money than you need. What do? That means reduce that money. So I have to take off 700 Ghana cedi from this money, then I'll get my 800. So that 700 Ghana cedi must be positive. This one means inflow. Why is it inflow? It's inflow because I have 1,005 there. Good. I have 1,005 there. And that 1,005 that I have, but I need 800. So that means the project must pay us. The project must give us money, which is inflow. Give us what? 700, so that it will reduce this cash flow to what? To 800. So that is it. So it must be positive. In simple quote, when it increases, put it in brackets. When it reduces, positive figure, you are done. That's all. Find the difference. When it increases, put it in bracket. When it decreases, put it here. Now the difference. So year 4, this and this, it has increased by 100. I'll put it here. And I'll put in brackets. That's the second assumption. Let's go to the last rule. Now let's pick the last rule. I hope the second rule is okay. Now let's pick the third assumption or the last assumption. Assumption 3. Assumption 3. Assumption 3. Working capital at the end of the project life must be recouped or recovered or released or cancelled. The working capital at the end of the project life must be recouped or recovered or released. That's all. So here, what's the working capital here? The working capital at the end of the project life is 900, man. This 900 must be cancelled, must be released, must be recovered, must be recouped. That's all. We are done. Good. So it must be positive. So the last working capital is what? 900. So I'll put it here, 900. Positive 900. That's all. I've recouped it. Whatever you have at the end must be recouped. Make it positive here, and then you are done. That's all. Basically, that is the game. Basically, that is the game. So we are done. But if you add all, it must be zero. That means it has been recouped or it has been cancelled. So you can try. Add all. So 1,000 plus 500 minus 1,000 minus 500 plus 700. In that order, if you add all, it must give you zero. Now I'm done. I'm going to write 3 examples. You try them right now. If you're able to get them, that's of working capital. Good. Yeah, that for management accounting, purposely, we don't normally consider that. We don't worry students about working capital. So far, we had one in one of the years. So I'll project that one too for you. Good. Now let's see. So let me cite these examples. You tell me how the MPV look like. I'll give 5 examples. Go to 5 examples. But for financial management, you need it. For financial management purposes, you have to understand every part of the game. Now listen. So let's assume that we have year 1, year 2, year 3, and year 4. These are working capital requirements. Yes, 200 Ghana. You don't need working capital here. You don't need working capital here. You need 200 Ghana here. How do you work on it? The same thing. That's example 1. Example 2. No working capital requirements. You don't need working capital. They start with project life. You don't need working capital. You need only 100 Ghana here. That's all. Example 3. You need a constant working capital of year 1, 500, year 2 to 500, year 3, 500, year 4, 500. This is what we mean by what? Constant working capital. A 4th example will be you need 500 here, dash, dash, 500, 500. I'm done. Start work. Kindly let me have your solution. Let me explain the question. All what I'm looking for is this. Apply the 3 rules. So we take the first one. You start with year 0, your year 1, year 2, year 3, and then year 4. And you take your time. So example 1, for instance, you apply all the 3 rules and then you record them here. Assume that this is the MTV layout. This is the MTV layout. You record them for me. Good. Great. Great. So the solution will be the first year. I need 200. So year 0 will be 200, right? In brackets. Now watch carefully. Year 2, I need 0. I don't need working capital in year 2. So whatever I have there, whatever working capital I have there, I have to release it. So I have to release that 200 to become positive here. Perfect. Yes, because I don't need working capital in year 2. Whatever I have to exhaust it. I don't know working capital, so it must be 0. So here, so dash. I need 200 Ghana here. You have to make it available at the start of what year 3. So I put 200 Ghana cedi here in bracket. Whatever I have at the end, I have to what? Recoup it. So it was 200 positive. If you add all, you get what? 0. That is it. You raise, you cancel, you raise, you cancel. That's all. Yeah, down to what? The first one. Let's go to the second one. Second one, you don't need working capital. Only 1 year per you need working capital. That's what? Year 3. So for that one, all what you have to do is okay. Let me slow down. We are saying that we are going to apply the 3 rules. What are the rules? Rule 1. Working capital must be provided at the start of what? Each year at the start. So year 1 only provided when? Year 0. So I come and put it here. 200 negative. Then I'll go and relax. Assumption 2. It says that after the first working capital, it didn't say the first year. So after the first or the initial working capital, you only record the movement or the difference. So after first one, year 2, I don't need any working capital, is 0. But I've already have 200 there, I provided 200 there. So let me release that 200. Let me cancel that 200. So that 200 must be like this. You are done. So I'll put it there. Then when I go to year 3, I don't need any working capital in year 3. So which must be provided in year 2? No, I don't need. If I need something here, I'll provide it here. Good, but here I don't need anything. That means year 2, cash. I don't need to provide anything. Then I'll go to year 4. Year 4, I need 200. And that 200 must be there at the start of year 4. And at the start of year 4 means year 3. That must be in year 3, which is what? 200 negative. Then we said that the last assumption, working capital that any working capital which is available at the end of the project, like must be what? Recouped or recovered. So that 200 must be recouped. So it must be positive here, 200. Right then. Positive 200. Good. If you add all this, you have to get 0. We are done with the first one. Let's go to the second one. For the second one, I don't need working capital in year 1, cash. I don't need for year 2, only need for year 3. Year 4 too, I don't need working capital. So I'll go to wherever I need it, year 3. It must be provided at the start of year 3. So I'll put where? Good. Year 2. So I'll bring it here in year 2. So that will be 100. So dash 100. Agreed. I'll put in bracket. Good. And when I go to the next year, between year 3, year 4, I don't need any working capital. So I have to release whatever I have in the year 3 because I'll start it and then release it. So I have to cancel whatever I need. Good. So here, I have to make sure that I have to exhaust all the working capital I have. So you'll be what? 100 positive. And then the last year, dash. That's all. So I'm done with the second one. Now let's go to year 3. So the third example, that is the constant working capital. Every year I need 500, 500, 500, 500. How do you treat that one too in the MPV? So let me do year 3 here. Let me take this session off and do year 3. So the example 3, not year 3. I need a constant working capital. Now let's start again. Instead that the working capital for each year must be provided at the start of what? Each year. So at the start of year 1 means year 0. So I have to put 500 Ghana here. 0. Agreed. Then I'll go to the note 2 or assumption 2. After the first working capital, the rest of the working capital, you just look for the difference, the movement. But here I need 500. I already have it there. So do I need any amount? No. So there's no movement. Movement is what? Zero. So dash. No topping up. It's a constant. Here too, this time is dash. When you receive constant working capital, here too must be dash. And the final you have to recoup what? The 500 positive. Whatever you do, if you add all, you have to get zero. That is it. How we get it? So that's constant working capital. There was no difference, no topping up, no reduction. And I have it there. It's like you need 1,000 Ghana to run your business. At the start of every year, you have to provide 1,000 Ghana there. And you have 1,000 Ghana there already. And that 1,000 Ghana, at the end of every year, you make sure that you leave 1,000 Ghana available. So it means that you don't need to top up. And let me do the last one, 4. I think the 4 was one of your years. In November 2018, I'll put the question here. Then we do justice. So now I only need working capital for year 3 and then year 4, which my also must be constant. So this one will be provided when? Here. So I will call it in year 2. So for dash, and I'll put 500 here, negative. So when I'm done, I'll compare this and this to dash. Finally, the final year, I have 500 there. Must recoup positive. You are done. So that's the end of this illustration. Kindly get it for me. If you have any question, kindly ask. Not then let me back it with what? With illustration. Let me back it with illustration. Let me back it with illustration. Good. So far in our question, we've seen it for few times. Now let's back with what? Illustration. For me, I'll pick inflation, and then I think I'm done with fully with investment appraisal. So I'll pick very first question to do justice with. Please, I've uploaded this material on your platform. If you don't have it, kindly let me know. There's a question in it. If I see it, no, not this question, not this question, not this question, no, no. Is it Mauna? Yes, Mauna. That is Mauna. Yes. Mauna question 13. Mauna Limited. Mauna Limited. Now we will solve this question after some few time. But I just want you to go through just this section for me, and then we are done this section. Just this, the first sentence. In addition to the initial cost of machinery, investment in working capital of 0.2 million is required. That's the working capital requirement. Will be required in year 2. The examiner is clear. In what? Year 2. We didn't say year 1. We say year 2. Good. Now the project will last how many years? 4 years. You need it in year 2. So where do you record it? Must be at the start of the year. Here there are 2 assumptions that you can also pick the constant working capital, which also work for you. and then that is it. Now let's continue the game. So on that note, we are done with working capital. That one be your trial. In fact, I'll solve it today. So they did it in year 2. They didn't state anything again. So 2 ways to solve this question. So let me do it here. They need 200 Ghana cedis in year 2. They need 200 Ghana cedis in year 2. So year 2, they need 200 like this. They didn't state anything again. So when you are solving it, you can have 2 assumptions, 2 rules. So in your MPV, we have year 0, year 1, year 2, year 3, and year 4. You can assume a constant working capital. That means here also 200, 200. Even though there's no per year there. So if you assume that, then this is provided when at the start. So that's year 1. You'll be dash. You put 200 Ghana cedi here, dash, dash, and then you make it positive, you recoup it. That's the first option available. Second option, if I didn't say per year, they just say this. So it suggests that they only need it for year 2. Only year 2, so you'll be dash, dash. So in that case, you still bring it dash in year 0, and then bring 200 Ghana cedi here, and you have to recoup it, the remaining one, dash, dash, you are done. So these are the scheme. So you can adopt any of these services. I'm done with working capital. Now let me touch on the last item, and we are done with the NPV for now. The last item that I will touch is inflation. 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 So inflation, you're welcome. And this one, a bit important. Inflation. 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 How does inflation affect the MPV? So now let's see. We said that inflation is what? Increase in the general price level. Good. So as soon as you mention inflation, 2 things will come into mind. The cash flows. You know that we are at year 0. Assume that I want to start a project. Okay, let's start a project. Yes, we want to bring, set up educational facility. So educational facility. I'm thinking of bringing degree programs and then professional programs. Okay, we said, okay, in year 1, I'll get 50,000 Ghana cedis. I am now here today. I've not factored in inflation, or I've not considered inflation. That's, oh, if I'm able to estimate 50,000, and you know that prices would definitely increase or will rise up in future. So that will also increase my items. So that's all. But I'm talking plain. All what you need to know is, as I mentioned inflation, there are 2 types of cash flows. We have what we call real cash flow, or the cash flows are in today's terms. I'll write all the other names for you. The cash flows are in today's terms, or we call it today's prices. Today's what? Prices, or today's price. The cash flows are in today's terms or today's price. That is real. It means that the cash flows are without inflation. They are without inflation. has not been inflated. That's it. Then we have the second type of cash flow. That one, it has been inflated. Yes, inflated cash flow. We call it nominal cash flow. Nominal cash flow. Or we also call it, instead of today, it will be what? Future or money terms. The cash flows are in future terms or future price or money. L'argent, right? Yes, money terms. Good. The cash flows are in money terms. That means it's a nominal cash flow. Finally, the cash flows are with inflation. So with inflation. It's also called growth. The cash flow will increase. So that's the growth. Increase in the cash flows. So take note. This thing is very important. How does cash inflation affect your cash flows? Inflation will definitely increase your cash flows. Yes. It will increase everything. Inflation will increase the discount factor and will also increase what? The cash flows. So the inflation will increase these two items. That is it. Great. Now let's see. Now, here, we don't want mismatch. Match them well. If your cash flows, they are without inflation, that's meaning they are real cash flows or they are in today's terms. We also call they are in current terms. Let me also put that one there. Current. Current terms. Take note. Yeah, exam now we use one of these terms in exams. And I don't know the one is going to be done. I have to be factual. We definitely use one. So take note that any of them that we use, you get it from me. Now, if this section is very important to red pen. If the cash flows are without inflation, then select a discount factor or a cost of capital, which is also what? Without inflation. So that one must move with what we call real cost of capital. So real discount factor. Real what? Discount factor. So if your cost of capital real, cash flows must also be real, so that it's like moves together. Your real cash flows, they are without inflation. Then select a discount factor to that do not what contain inflation or that not be inflated. That's all. Now when you come here, nominal or future price terms. Good. Nominal or future price terms. Good. That one to select the nominal discount factor. You see this one here? Today's price. Today's what? Price. They are in today's terms or they are in current terms. That's the term that we are going to use for you. Good. Today's terms, current terms, or today's price. Good. Now with the nominal cash flows, if the cash flows has been inflated, then use what we call a discount factor, which has been what inflated, and we call it what nominal discount factor or nominal cost of capital. I'm done. Or we call it money rate. Nominal. We call it money rate because there is cash flows are in money terms. That's all. I am done. Now, sometimes you'll be moving you through discount factors. You might need the nominal discount factor, but we'll give you what? The real cost of capital. So what do? You have to convert the real cost of capital to what? The nominal cost of capital. Now, the cash flows, you have to inflate the cash flow unless otherwise stated. So that's all. So I'll look at them. First, how to inflate cash flow. Two, how to estimate the real and the nominal cash discount factor. That's all. So you need to know what? Two items. Then we are done. So let's move on to the next level. Or the assumption that inflation will increase your cash flow. That's all. So first, you should know how to inflate cash flows. How to do what? Inflate cash flows. That's the first thing you have to know. Two, how to estimate the real cost of capital or real discount factor from where? From the nominal, and vice versa, or the nominal discount factor also from where? Real. Yes, because we not give you the two, we give you one. Then you have to use what we call Professor John Fisher equation. So Fisher's equation will help us to estimate the cost of capital. Basically, that is it. So I'll just that my first question, we are not going to inflate the cash flow, but I'll pick an illustration, or I will illustrate how to inflate cash flow. Then I'll go straight to estimating the discount factor, then I'm done. Good. So let's see how you're going to estimate the cash flow or inflate cash flows. First, let's assume that I have projected selling price, sales revenue, maybe year one. Year one is, let me put it there, 30,000 Ghana cedis. Year two is 40,000 Ghana cedis. Oh, yes, you can make that money. Oh, this one is small. This one is just 70,000 Ghana cedis. Year three. It's only up to year three. Yeah, they have to give you the inflation factor or the inflation rate. Please, there are two types of inflation. Let me explain it. Even though here you don't need it too much. Types of inflation, you have what we call general inflation and what? Specific. Specific inflation. For those who are doing financial management, you need this. General inflation and what? Specific inflation. In fact, general inflation affects everything. Specific inflation affects only specific items. So I can give you, have you seen the NPV layout, sales revenue, variable cost, contribution, what again? Fixed cost, profit, and all the items. We can inform you that each of them have a different inflation rate. That's what we mean by what? Specific. Maybe sales revenue is 5%, variable cost is 3%, fixed cost is 2%. You are done. This is what? Specific inflation. Then with a general inflation, I can inform you that, okay, the general inflation is at the rate of 7%. That means every item here will suffer inflation of what? 7%. That's the implication. Good. Now that is it. Good. So now we know general inflation and specific inflation. For management accounting, we normally relax on the specific. So we go in for the general inflation. So most of your exam questions, if there's inflation in there, it will be general inflation. So take notes that your exam question mostly be on general inflation. So I'm just assuming that the inflation rate is 8%, single digit. So inflation is at 8%. How do I inflate the cash flow? Don't worry. Bring the inflation, get the sales revenue. So right here, inflation. We said that inflation will increase, right? So if inflation will increase, then all what you have to do is add it, convert to decimal. So that's 0.08, add it to 1. So plus 1, making what? It will be 1.08, 1.08, so 1.08, 1.08. Yes, 1 year later. What's the base? Maybe the base is 0. So here's 1, 2, 3. That's different here, 3. Please, sometimes inflation can start from the next year. Inflation will start from maybe here is 0. It will start from year 1. Let me explain that situation. If I inform you that the sales revenue for year 1 is 30,000, and thereafter it will increase by 8%. That means I have to start inflating the cash flow from where? Year 2. They told me specifically that sales revenue was 30,000 for year 1. And thereafter, so here must be 30,000. And it's already calculated inflation. That is it. But if you don't see those terms there, then the inflation must start from where? The normal one, year 0. Sorry, the year 1, year 1, 2, and then 3. So kindly calculate it for me. Let's know the inflated sales revenue. So inflated sales revenue will be inflated sales revenue will be 32,400. I'll take that. Year 2 will be 34,990. $34,990. Great. Can you get them? So inflation be 46,000. Year 2 is 46,665. Think year 2. Okay. It must be 46,656. So 656. And then year 3 will be 88,180. 88,180. So this is how you inflate the cash flow. Then you use this one in the MPV calculation. So in the MPV, your sales revenue will be 32,400, not this 30,000. Because the cash flow must be inflated. Agreed. Perfect. So that is the inflation. Now we are done estimating or inflating cash flows. Let's go to how to estimate the cost of capital. That's where you need, it's very important, the cost of capital. Now, can I take the, now let's estimate the cost of capital, but that's actually very important. So we said there are 2 types of cost of capital. I'm going to use real rate, nominal rate, and inflation. These are the 3 variables that you have to know them. Real rate, rate without inflation. Nominal rate, rate with inflation. and then I, the inflation itself, and here it must be the general inflation. The general inflation. So now, Fisher is saying that relax. The nominal rate is nothing but the real rate times what? Inflation. That's what Fisher is saying. Fisher is saying that if you give him a real rate and inflation, you can predict that country's what? Interest rate or the nominal rate the same way. So if I should introduce them, these percentages, you normally add 1 to it, right? So the original formula now, add 1 to everybody. That's all. Add 1 to everybody. So to be n plus 1 is equal to r plus 1 times what? Into bracket I plus 1. How do you get this? So this is the formula that we are going to use. So for instance, if the real rate is equal to 12% and general inflation is at the rate of 5%, what is the nominal rate? Question mark. Nominal rate is what? Question mark. Good. Nominal rate is question mark. Nominal rate is a question mark. So how do you find it? The real rate is 12. So to be bracket here, that is 0.12 plus 1 times what? Inflation of 5%, 0.05 plus 1. So therefore, it's equal to 1.12 times what? 1.05. So the answer will be, so that will be 1 dot 1 dot 1 dot, I like that, 1.12 times 1.05. That's 1.176. How do you get that? Good. Now realize that we have this section there, right? So I have to be adding it. So n plus 1, n plus 1. Now make n the subject. So here to be n will come here. This and this will give us 1.175. So therefore, finally, this one have to go there to less what? 1. So therefore, the answer will be n is equal to 0.75, which is equal to 17.5%. You multiply this one by 100, it will be 17.5. It's 0.6, sorry, 17.6%. So 17.6%. So therefore, nominal rate will be 17.6%. We are done. Perfect. Now you are going to try this. You are going to try this. Now you are going to try this for me. You are going to try this for me. You are going to try this for me. Now let's assume that the nominal rate is equal to, nominal rate here is 18%. General inflation is what? 7%. Please don't add them and don't subtract them. What's the real rate? Don't tell me that it's 11%. So this man is no. Follow the principle. So that is it. So it to be 17.6%. But I've changed it. Now the nominal rate is 18%. Inflation is 7. What is the real rate? Start work. How do you find it? Still go through the same process. Make the real rate the subject. You are done. If you like, you can add the college, do the substitution. So let's start the whole game again. The substitute. Nominal is 18. So 0.18 plus 1 is equal to real, I don't know, plus 1 times what? Inflation is 7. So 0.07 plus 1 like this. So solve everything. Now get 1.18 is equal to real plus 1 bracket 1.07. So they are multiplying times 1.07. What do I do? So I have to divide both sides by what? 1.07. I have to divide here by what? 1.07. This one take this one away. Agreed. So therefore 1.18 over 1.07 is equal to R plus what? 1. So solve this one for me. Or finally, I get something like, let me do it here. I get something like 1.18 all over 1.07 less 1 is equal to the real. So you stop this one alone, you take 1 from it. And what's the answer? Well, then I'll give you a straightforward formula to find the real rate. Good. So the answer will be 1.18 divided by 1.07. So that's okay. So the answer is equal to, so finally it will be equal to 1.1 for the finance. I'm continuing from here. So you are getting something like, so you get 1.103 less what? Less 1 is equal to the real rate. So therefore, the answer is what? 0.03. So that will be 10.3. So therefore, this will be 10.3. 10.3. Good. That will be 10.3. Therefore, it will be 10.3. I'm done. So this is how far the good Lord bring us for the adjustment. Now let's pick one question to do justice. I'll explain the question and then you try on hands on them for me. 2 questions. I'll explain 2 questions. Go and work on them and then you bring it back. Then we see. Good. But if you do have any question, kindly ask. Then you'll be fine. Let's see. Okay, so now you're going to solve this question fully. Marina. So Marina Limited, a manufacturer of what building materials, has recently suffered falling demand due to economic recession and thus has unutilized capacity. Oh, that means Marina can make an investment decision. Good. Management has identified an opportunity to produce designer ceramic tiles for the home improvement market. It has already paid 1.5 million for development expenditure, market research, and feasibility studies. Are you going to include this cost? No, this cost is what? It's a past cost, so it must not be part. So you don't need to touch this. As usual, not all informations that are in the question you are going to use to answer. This is what you call past or sunk cost. It does not qualify. It's not a relevant cost. So you ignore. Good. You ignore. You ignore. Then let's continue the game. We said the relevant cost must be what? Cash flow, incremental, and what? It must be in future. Perfect. But this one is not in future. It's a past cost. Whether Maona and I take this project or not, that 1.5 million has already incurred it. So It has no bearing on this project. Now let's continue. A new machine with useful life of 4 years could be bought at 6.5 million, payable immediately now, year zero. Thank God. Immediately, year zero. The scrap value of the machine is expected to be 5% of the cost, recoverable a year after the end of the project. For year two, there was a wahala. The scrap value will be what? Recoverable a year after the project life. So that means it will be when? Year 5, not year 4. The project will last for 4 years, but the scrap value will be recovered when? The payment, you receive the money in year 5. So find 5% of the asset value. So 6.5 million, 5% of it is the scrap value. But you're going to include it in year what? Year 5, not year 4. Perfect. Let's continue. The Market Research and Development Division has prepared the following demand forecast. Demand, all of them are there. For this question, it's just a remix of what happened in 2017 November. Yes, and that question is in. That's Ajasco, right? Is that Ajasco? Now let's see. The selling price is 50 per box at today's price, meaning without inflation, real cash flow. They've not inflated it. That's good. Operating costs largely based on experience are as follows. Cost per box of tiles. Cost per box of tiles at what? At today's price. Wow, material, direct labor, variable overhead. So which of this will form part of the variable cost? Now you add all. We said the fixed cost, we don't apportion or neither allocate fixed cost. It must be directly attributable. So we are not going to include any apportioned fixed cost. So take note. So you add all except the apportioned fixed cost or allocated fixed cost, shared fixed cost. No way. That's all. In addition to the initial costs of machinery, investment working capital of 0.2 million will be required in year 2. So we've talked about the working capital. Mauna Limited paid tax 1 year in arrears. So that means tax must be lag behind time. At the rate of what? At an annual rate of 30% on returns from the project. Mauna Limited shareholders required a nominal return of 14% per annum after tax, which include allowance for general expected inflation of 5.55%. Ignore working capital. Ignore capital allowance. Now look at the requirement. Required. Assess the financial desirability of this venture in real terms, please. They say what? Real terms. Do not inflate any of the cash flow. Okay, so if it is in real terms, the cash flows must be in real terms. And hence, the discount factor must also be in real terms. But here, there's a danger. You have given us a nominal cash flow, nominal discount factor of 14%, and the discount factor of 5.55. So that means with the help of Fisher's equation, we can what? Find the real. If you do that, you get 3 marks. If you're able to do that, 3 marks for you. Good. And that's the end of the game. Great. So you will try this. Yes, with the help of this, kindly try this for me and then you'll be fine. Now let's go down again. There's another question that I want us to look 4. There's another question. That question was the mock question for 2018 November. And then when they went, they saw this question. So let's go and see that question. Good. So this one will be your own. Great. So you are solving two questions. The Mawana question, that's question 13, plus this very one, question 3. Danko. So these two questions are yours. I am done for the day. Unfortunately for us, this is how far the good Lord will bring us. On that note, we will continue. But if you do have any questions, suggestion, contribution, kindly let me know before I close the chapter of the game. Great.